Good morning, everybody. Mike Tedeschi, investment strategist over at Perspective Wealth Planning. This week, we'd like to take a look at the four major U.S. indexes. We're also going to take a look at earnings growth and what that could mean moving forward, taking a look at some previous data. And I also want to take a look at some sentiment data, which is something we haven't talked about here in a little bit, that actually could be very important based on the readings that we're getting. But first, let's just take a look in technically at the market. Now, the last couple of days here on the S&P 500 and the rest of the indexes, we've seen a little bit of a pullback. And I've started to see once again, people trying to call the market here is topping out. And if we just think about things technically and don't put anything else into this, we have a breakout, and currently this could be that back test of the breakout, right? Really, the only way that the bears can cry any sort of success right here is if we get back under those major breakout levels. So on the S&P 500, that would be that 2950 zone. Underneath of that, then you could start to talk about this being a potential false breakout if you can't hold over that major level. We take a look in at the Nasdaq. Same thing. 7,800 levels was those highs from back in April. Again, tiny little bit of a pullback right in here, but it's still holding above that level. It's above a rising 10, 20, 50 moving average. Let me go ahead and throw that 200 moving average on here as well for you guys. The 200 on the Nasdaq started to turn up there as well. And we come in here and we take a look at the Dow Jones. Again, we've got the rising 10, 20, 50, 200. We're above that breakout level, even though we've had a couple of days of weakness here in a row, right? Unless we fall back underneath that 26,900 level on the Dow, right? All this is a breakout that's currently making that back test. And actually, when you're talking about technical analysis, a lot of times if you miss the initial push for a buy, one of the things that people will do is they'll look for that back test of that breakout zone and try that as a long with a tiny stop against that, because a lot of times you get those one move forward, come back, test that breakout, and then you take off. Right, you can even see that play out here on this chart. Let's go back to the breakout that we've got on the Dow earlier this year in April. You'll see we have 3-4 sessions. I'm going to zoom in for you so you guys can really see that. You have 4 or 5 sessions up, and then you get a pullback. And where do you pull back to? You pull back right to that breakout level, and that ends up holding, and then you turn around and you continue to head higher. So really, again, the bears can't say that they've accomplished anything until you get back underneath of those breakout levels. Now, the one area of the market that we still have no breakout at all would be the mid caps. The Russell is still extremely weak. All right, I've actually put this on here, right? This could be that potential head and shoulders top. We've got that 1600 level, really is that resistance point. We're still 11-12% off of those highs put back in last year. Has continued to lag. Hasn't even made a new high since May, where again all the other indexes are making new all-time highs. So this still continues to be that area of concern for the overall market. And when we see the mid and the small caps really pushing to the upside, right, we have that risk-on environment. People are willing to buy those riskier asset classes and take additional risk, and that usually shows a healthy appetite for risk, and that ends up being a good thing for the overall market. But when we get mid and small caps lagging substantially like we've had, right, and again, we took a look at it a couple weeks back. A lot of the names that had really started to make the breakouts before the major indexes were utilities and staples and yield plays, so safety plays. So we still do not have that full rotation back onto those major risk areas of the market, which would be the only concern that I've got from a technical standpoint. Now, let's take a look at a couple of things in regards to earnings growth. So what we have here, we have earnings growth quarter over quarter shown here on the bottom portion. I'm sorry, a year over year change shown on the bottom portion of this chart right here, and then the S&P 500 is up there on the top. And you can see that we have gone, we have negative growth at this point in time right here. And it had been trending up for a while, and you notice when earnings trending up, the market tends to trend higher. When you do have that negative growth, right, you get a little bit of a dip right in here, but nothing spectacular. Again, this doesn't mean the market makes any sort of crash or anything like that, but when we actually take a look at the numbers themselves, when we make a multi-year high and then we're 2 weeks after a quarter end with negative growth, which is what we're at right now, you take a look, and we get out a couple of months, and it's about a 50-50 split between whether we're positive or negative, and the risk to reward is also about that 50-50 zone. So, this is not saying, really anything super negative. But what's really interesting is when we look at this data, instead of taking a look at all quarters, we just take a look at the end of Q2. Something very different happened. Now, the subset of this group is only 5 instances, but look what happens 2 to 3 months out when we were talking about the S&P making a new high 2 weeks after the Q2 ends with negative growth, only positive 20% of the time, with a big skewed in favor of the bears, with almost a 2-to-1 in terms of risk to reward. Why is that? Well, one of the things is that we can really think about when we start talking about the second quarter of the year is seasonality and what happens seasonally as we get into summer. If we even pull out just the earnings miss, and we just take a look at the 2 weeks at the end of Q2, we can see within a couple of months we have big negative numbers, right? 44%, 33% risk to reward skewed. And this is 2-week high at the end of Q2, and month to 3 months out, the market has a very negative skew to it. And then 6 months in a year, it's got that positive skew once again. Why is that, right? Seasonality. That's what we were talking about. So when we pull up a seasonality chart, taking a look over the last 20 years, right, we can see here the beginning of July to, basically into that August and September zone. The market typically tends to see a little over a % type of pullback. In fact, the middle of the year as a whole tend to be, pretty range bound, and we get our big expansions the end of the year, and a lot of times the beginning of the year starts off negative, and then from March into the middle of the summer, you have that upward momentum. Right, seasonality is not a perfect science. Again, what's happened in the past doesn't mean that's exactly what's going to happen here. But a lot of times in the summer, we hit lower volatility, and then that old saying, "Sell in May, go away." When we actually look at the seasonality of the market, there typically tends to be some roughness there in June and in July. So it's not a statement that has no basis in fact. So that's one of the things that we're paying attention to. So again, when I take a look at that data and you're looking at 2-3 months out, the market being extremely skewed to the negative side, is that really because earnings growth being negative there is a major concern for a quarter, or is it more having to do with seasonality as a confluence of multiple things? And as you can see, it looks like it's a confluence of multiple things at that point in time. Now, there's one other thing that I would like to talk about in today's video, and that is sentiment, and this is something that actually I have a lot of concern about. We are going to take a look at retail traders making bets on call options and what that means. All right, so what this is looking at is looking at small trader call option buying as a percentage of the total volume of calls that were traded. And what we can see is anytime we get above that 40 level, the market has had some issues. And I'll actually show you the numbers here in just a second. But you can see beginning of 2018 when we had that big pullback, the retail traders got extremely bullish. And then once again, we're up over that 40 level. A few months later, we have that little pullback, and then once again, they got extremely bullish into right before we had that sell-off at the end of last year. They got extremely bullish earlier this year, right before we had that pullback. I'm going to pull up that chart on the S&P. They got extremely bullish right here before we had this month-long slide. And here we are once again at that, heading into that 40 level. This has been a zone where we see very high percentage of the time where we get a pullback, and it's because too many people getting on one side of the ship, essentially the boat, can roll over. And when we get that bullish, when the retail traders, they get that far on one side, it ends up being a concern. So let's look at the actual number. Over the last 20 years, when small option trader call volumes above 40% for the first time in a month, going back again for 20 years, right, the market has a very negative skew from that 2 to 6 month zone out, right? And it's a big negative skew. The percent positive is well below 50, but the risk to reward, again, really favors the bears there. In the short term, it didn't play out as much. The first week, the second week, slight advantage to the Bears, and then we really don't see it again until like 2 months. So there's a lot of times where you get too bullish right in front of some major pullbacks. You go back and you look at 1 year later, these are some of the most negative numbers. It's a positive 50-50, but when it does go down, it goes down a large percent. The average loss on that being 15%. And you can go back and you can take a look at these numbers here. 1 year later, 10, 15, 27, 12, 7, 12, 35, percent in the negative. So there's some big moves to the downside, and that is because it doesn't mean it happens every time, but it certainly can be a one of those topping signals, as you can see there back in 2000, 2007, 2008. However, again, 2004, 2005, 2006, it didn't say that we're topping out here. Same thing again in 2010, 2011. So take this with a grain of salt. It's just another thing that we can take a look at and have a little bit of concern there for the long term, as retail traders get too loaded on one side of the boat. Typically that ends up not working out so well. Takeaway from today's video, guys, look, there are certainly some negative components when we take a look at some fundamentals out a month or two from now. When we take a look at the technicals, we're still over those major breakout levels. And really, until we get back underneath those breakout levels, we can't be looking at this market and be bearish. If we do get back under those breakout levels, all of a sudden we have a false breakout scenario that has developed, then some of these fundamental things, the seasonality components that we've just talked about, certainly could exacerbate the selling. But we'll have to continue to monitor that. As for now, if we hold that 2950 level on the S&P 500, all we would have would be a breakout, a back test. And again, when we look at this chart on a monthly basis, this could be a multi-year breakout, and this could be one that really does have some legs to the upside. So as we're fighting kind of right there on that breakout level, really important to see what happens. We'll continue to stay on top of it. As always, I hope you guys find these videos helpful. See you guys next week. Take care.